Forefront Wealth Management team, and we're here today to host our 2025 Q1 update with our partners at William Blair. Today, I'm going to turn the meeting over to Alex Scull, our direct connection with William Blair and his teammate, and we'll let Alex go through a presentation. Alex and his team will go through a presentation of overview of the markets. Will take us about 15 to 20 minutes to go through that. And then at the end of that piece, we will go through some common questions, take some questions from the audience, and we should be done within about 30 minutes. So, Alex, I'm going to turn it over to you. Thank you for spending some time with us today.
Absolutely. Thank you, Adam. Thank you, Jill. Thank you to the broader Forefront team. My name is Alex Scull. I'm joined party. We work on the custom high net worth team at William Blair and are honored to work on many client accounts that are represented on today's call. Our primary responsibility is portfolio management for high net worth clients, and we work with fantastic advisors such as the Forefront team to make sure that we are prudently accomplishing the goals and objectives that are set out for each of your portfolios. I've had the privilege to be part of more intimate, maybe one-on-one type of portfolio reviews with many of you in the past. Today is a little bit more of a general conversation. Really, we want to get in the habit of just make sure that we're sharing with you how we're thinking about markets, any broad-based. It's difficult to speak to portfolio specifics in this format, but we'll do our best to make sure that we incorporate themes along the way. I do know that I don't want to waste any time with more biographical information, but I do think it's helpful just to set some context about our approach to portfolio management, who we are as a firm. William Blair has been working with Forefront for a few years now, but the firm itself dates back to 1935. We view ourselves as a full-service investment boutique. And so by that, I mean, yes, we have asset management. We have wealth management for clients like yourselves. We have institutional management. We also have an investment banking arm. And so really, we touch many different aspects of the business. We steward over $160 billion of client capital. We are a private partnership, and we have over 20 offices globally. You won't see a William Blair ATM or a commercial shingle anywhere, but there are about 10 offices in the United States. I'm joining you today from New York. Ray is joining you from Chicago. And really, we have just a very broad-reaching investment presence. With that said, beyond just the footprint, we do have, I would say, also a global approach to investing. While the bulk of client accounts do skew towards US-oriented investment, we like to keep tabs on what's happening outside the walls of the United States and make sure that we are incorporating any sort of relevant non-US exposure where appropriate. We do so really by leaning on a team of research analysts. We've got about 40 analysts in-house that cover, it fluctuates, but between 700 and 800 companies. And so when we're putting together portfolios for clients such as yourselves, we are relying very much on the inputs from these research. Just to give you an example, a client account would oftentimes consist of anywhere from maybe 40 to 60 stocks, of which we are getting ideas pumped to us daily from the research team. To complement that, we also are oftentimes buying bonds or some form of fixed income in client accounts. And so between this mixture of equity exposure and fixed income exposure, we can manage a broad set of asset allocation for clients and make sure that we are approaching the goals and objectives of each specific client appropriately. And so I think today what might be helpful to get started is take a look backwards, perhaps, at
So Ray, all of a sudden, Alex got a little jarbled there, his internet, which is okay. That's why we have a team. And if you can pick up and go into more of the overview deck of today. Again, our clients, as Alex has been working with them, he knows our clients. We've worked with you as well, Ray, one-on-one with our clients behind the scenes. And our clients are high net worth individuals. Some of them are still in accumulation mode, some of them still in distribution mode. Some of them are kind of straddling both phases. Uh, we just came off of a 2024 year that was a robust market year. Seemed like there was not many areas of the market that were down. There were some, but for the most part, it was a very uh, uh, prosperous 2024. And so we want to kind of get an overview of how we did last year and
Sure.
maybe the whys, and then looking forward in 2025, Q1 and beyond, where are we going? And any land, any landmines that we should be thinking about or that you guys are thinking about.
Sure.
And obviously we have everyone's always, the media is driven by what's our political landscape happening, what's happening with tariffs, all those things we'll get into. But if you can just kind of give us a broad stroke, how did we do
Yeah.
last year and where we're going this year?
Yeah. Yeah. Sure. Thank you. Thank you, Adam. Thanks, Jill. And again, this is Ray Lombardi at William Blair. Just to avoid any confusion, I think my little window says Alex Skull as well. So there are two different people here from William Blair. But as Alex mentioned earlier on, I'm a portfolio manager here at William Blair, working very closely with Adam and his clients. And please know that we consider ourselves to be really an extension of Adam's practice and a resource. And so, with that, yeah, just to kind of take stock of where we've been and ultimately hope to have a bit of an influence on where we might be going. We're coming out of a 2024 that in general was pretty strong for capital markets across the board. And so we have you can hopefully see on the screen here a summary of the different areas of capital markets. We're showing this is through the end of January, actually. So it's a little bit updated, but before I focus on year-to-date numbers, I would call your attention to the two columns on the right side of the page. So 2024, you can see the top row, the S&P 500, the index we really hear the most about in the news, maybe second only to the Dow Jones Industrial Average, but the S&P 500, which is often considered to be a really good barometer of what are the biggest and kind of most well-known companies in the U.S. stock market doing, and that was up 25% in 2024. That follows a 2023 where markets were also quite strong. I think the S&P was up 26% in 2023. So in terms of where we've been, we really just came off of two pretty strong years in the stock market. And one thing that we've been sharing with clients recently is don't get used to that. I think there's a lot that goes on with investments around setting expectations and things like that. So to see 2 years in a row of 25+% returns from the S&P 500 is very, very unusual. Historically, over the past 100 years, the average return of the stock market year in and year out has been about 7 or 8%. So to see 3+ times that amount in terms of returns over the past 2 years is very unusual. The other piece about that too is that those returns have not been as broad-based as maybe some of these headline benchmarks would lead us to believe. And so one of the key themes that we've been talking to clients about, and we'll get into this a little bit, is that markets have really been led by a handful of companies, and in particular, big technology companies, which someone coined the phrase the Magnificent Seven. Those companies have really been leading the way for the past 2 years. And so we'll talk about those dynamics a little bit in the coming minutes here. But overall, 2024 was good for markets broadly. The US stock market led the way. We also saw, as we look further down on page 2 here, international markets. The MSCI All Country World Index was up 5.5% in 2024. The emerging markets index, which would be China and India, Brazil, those sorts of countries, those were up about 7.4% during the year. And then bond markets actually eked out a positive return in 2024 as well. The broad-based, the Barclays US Aggregate Index, which represents the investment grade, the higher quality parts of the bond market, was up about 1.25% in 2024. The municipal market, your tax exempt bonds that come from different states and cities and municipalities, that was up about 1%. The best part of the bond market was actually the riskiest part of the bond market, which was high yield bonds. Those were up almost 8.2% in 2024. And then finally, the last row on this page, the REIT index, real estate, US real estate, was up just under 9% in 2024. So across the board, we really see a lot of green on the screen, if you will, in terms of overall market returns. That's interesting when you kind of compare that to, well, what happened in the fourth quarter? And a lot of times in markets, you'll see some what some will call a Santa Claus rally into the end of the year, where markets do well as people look at their portfolios, reposition a little bit, and there's just kind of a general better feeling as you close out a year, start a new one. Well, we didn't really necessarily get that Santa Claus rally this year. And you can see in that second column from the right, the fourth quarter returns, you have, I would say, a mixture of results. I might start a little bit further down the page here. In the middle, you can see international markets were actually down. So even though they had positive returns for the year, they were weaker in the fourth quarter. The international markets were down 7.6%. Emerging markets were down 8%. That stems from the US presidential election and a lot of the conversations that were taking place around more of an America First agenda, tariffs as a possibility. A strong US dollar continues to be a guiding factor in international investing. So you saw some pretty serious pullbacks in those areas. You've also seen a little bit further down on the page, bond markets pulled back a little bit as well. And so some of that is also attributed to some of the things that were said on the campaign trail and some concerns that folks have heading into a new year. Well, geez, inflation is maybe going to be a little bit stickier. What does the growth outlook look like? Are some of these policies potentially going to be inflationary? And so you saw some weakness in bond markets as well. All that being said, I want to draw, again, sort of our attention back to this theme that we've been tracking. And if we go back to the top of page 2, S&P 500 was up 2.4% in the fourth quarter. But if we look right below that, the S&P 500 equal weight was in negative territory. And so this is something that's worth noting and is even potentially more pronounced as we go a little bit further down the page. The Russell 3000 Growth Index was up 6.83% in the fourth quarter, whereas the Russell 3000 Value was down almost 2% in the fourth quarter. And this again goes back to that concept that I mentioned earlier about the leadership of a handful of stocks, the Magnificent Seven. Those really, again, led the way in 2023 and 2024. And in the fourth quarter, what we're seeing is the market broadly was a little bit weaker. That's what that second row, that S&P 500 equal weighted, suggests, that the broad market was actually not as strong as that headline S&P 500 number would lead us to believe. The influence of those companies has grown to be pretty significant. And so as we think about where we're going and we think about some of the dynamics that we're seeing in markets just over the course of the past 5 weeks since 2025 began, the concentration of the Magnificent Seven and their influence continues to be something that is on investors' minds. It's on our minds as we manage portfolios. Within the S&P 500, not all 500 companies are created equal. The S&P 500 is what's called a market cap weighted index, meaning the bigger the company, the bigger its size and its positioning within the S&P 500. So here on page 4 in the upper right, we can see this is as of the end of January, but the concept is still the same. At the end of the year, the top 10 companies in the S&P 500 accounted for nearly 39% of the weight of the S&P 500. So ultimately what that means is their influence is significant. So if they're doing well, they kind of bring the rest of the index along with them. And if they're not doing so well, they kind of bring the index down in the other direction. You can see that on page 5 here in the upper left. In 2024, there's these different calendar year returns. We just saw in 2024, again, the S&P 500 was up mid 20% in 2024. the Magnificent Seven stocks, which we can see listed on the bottom of the page here: Apple, Amazon, Google, Facebook, Microsoft, Nvidia, and Tesla, all basically technology-oriented companies. Those were collectively up 48% in 2024. All the other companies not in that group were up about 10%. So that's where we get our average return for the S&P 500 was, on this page, it says 23%. Similar and even more pronounced dynamic in 2023. Those 7 companies were up 76% in 2023. Everyone else was up 8%. And so that's why we had another really strong year in 2023. The year before that, 2022, this is where their influence works in the opposite direction. The S&P 500 was down 19% in 2022. Markets in general, we'll recall, were weak in 2022 as the Fed started to raise interest rates. Bond markets were down quite a bit too. Those Magnificent Seven stocks were down collectively 40% in 2022, whereas all the other 493 stocks in the S&P 500 were down 8%. And so this dynamic works in both directions. And I would say for us, as we think about where we are, kind of where we've been, where we're going, this concentration and this influence of those Magnificent Seven stocks is something we want to be mindful of. And we've actually already seen, as we've started 2025, Nvidia being the most notable, you've started to see those companies pull back a little bit. Some of that can be attributed to investors just saying, oh, hey, it's been a good run over the past 2 years, but I need to take some chips off the table. You've also seen 2 weeks ago, a Chinese company called DeepSeek announced that they had developed their own artificial intelligence model that was rivaling those built by US technology companies. They had done it really faster, more cheaply, and made it as effective and less resource intensive as what some of our own homegrown technology companies have done. And so that was kind of a shot across the bow for our own technology companies. That's why you've seen on this page, you can see the Magnificent Seven are actually down on a year-to-date basis. And when they're such a big part of the index, their weight does have a negative impact on the overall market returns as well. So their concentration is a bit of a risk from our standpoint. And so when we get down to the portfolio level, a big part of our job is risk management. We're not going to have 40% of a client's portfolio in a handful of names. We have exposure to most of those names, but we don't have nearly as much as what's in the benchmark. So I think lack of concentration, but also just a broader based portfolio. We're looking at different sectors. We're looking at companies of different sizes. That diversification so far has played out well in client portfolios on a year-to-date basis. And we would expect that to continue as we move forward. One other thing that I'll say too is, so that's, one of the key themes has been within the stock market has been that concentration. I would say in general, one of the punchlines, hopefully, that you take away from our presentation today is that we still have a constructive view on capital markets, on investment portfolios. A big part of that has to do with we're going through earnings season right now as well. And we're about 3/4 of the way through earnings season. Companies have, in general, had favorable earnings reports. And the outlook for many companies, many industries is positive. So when in the investment world, there's a very close tie between a company's earnings and growth of those earnings and the company's stock price. And so there's a lot going on page 8 here in terms of the earnings scorecard. But in general, there seems to be positive momentum from an earnings standpoint. Companies are managing well in this post-COVID world. And even though there's some uncertainty coming out of Washington right now, the general feeling is that there should be, neutral to positive, lack of regulation, friendlier policies for business. Maybe we get a more favorable tax situation. So there seems to be more of a constructive kind of high-level backdrop that helps to support earnings and growth and continued positive progress posted by corporations. And so this is one of the more constructive elements that we would say as we move forward. It continues to support a constructive view from our standpoint as we make investments and build investment portfolios. And in general, we've seen our portfolios holding up better so far early on in 2025 because of the diversification, because of the quality approach, paying attention to earnings momentum and potential growth there. And we do expect that to continue.
Thanks, Fred. Can you hear me okay?
Yep,
Yes.
we have you.
Fantastic. I think that that's very helpful, looking backwards as well as talking about, in some regards, what types of businesses we're looking to invest in. I do think putting that against the backdrop of 2025 is helpful as we think about risk. There's always risk on the table, and oftentimes when new risk enters the conversation, it can be scary, and we sympathize with investors that you need to be thoughtful about that. But I would say, that's part of our jobs is navigating risk in a meaningful and thoughtful way. Right now, I would say the headline risk that is making its way around revolves around tariffs, and to some degree, that's rightfully so. I think understanding the relationship between interest rates and tariffs and inflation is helpful. So Ray, if you could stay on the Fed funds rate for a moment, I think it's good just to level set. I believe most clients are aware, but really, we've been on a what we call an easing cycle for the better part of the past few months. Really, after COVID, and then subsequently the conflict between Russia and Ukraine, we saw inflation skyrocket. And that's a great chart. You see that peak really in 2022. That level of 9% is unsustainable, especially when the stated target is closer to 2%. Some may argue it's been adjusted upward since then, but the Fed still says 2% is what's appropriate. And so when inflation spiked, the Fed had to take action. And the tool at their disposal really is to control the Fed funds rate, which, without being overly technical, basically lays the path for other interest rates across investment services and finance. And so really we saw a tightening cycle for the longest time. That's the bar going up, followed by plateau, followed by an easing cycle. And so really that easing cycle is an indication that we feel like inflation has started to get under control. If you go back to that inflation chart, you see that if you were to transpose that over this, you do see the intended effect occurring. And so inflation comes down steadily, steadily, steadily. And now it's starting to kind of plateau again. It is still going down slightly, but actually that number on this page, 2.9, that's the December print. The January print just came out, and it was actually slightly above, closer to 3. And so you may have heard the term that in inflation, the last leg of inflation is sticky. This is what it's referring to, is really, getting from 9 down to 6, down to, 4 and 3. That happened quickly, but getting from 3 down to 2 may take some time. And so really, when the Fed paused just a few weeks ago in cutting rates, they indicated that they were comfortable with where we're at least for the time being. Now, that leads to the primary risk of tariffs and whatnot. I think folks hear the term tariffs and immediately assume something negative. Not necessarily the case. When you look at the tariff, essentially what's happening is there's the cost of a U.S. good and the cost of a non-U.S. good. And in order for this to economically make sense, the non-U.S. good is cheaper. And so a U.S. consumer is oftentimes going to go to the cheaper product, which may be manufactured outside the U.S. A tariff is essentially a tax applied to that non-U.S. good, which is going to make it more of a level playing field on price relative to its U.S. counterpart. Now, what that means is the U.S. consumer, who could have bought a non-U.S. good for cheaper, is now going to have to pay the higher price to get the same good, whether or not they buy the non-U.S. good or the U.S. good. And essentially, that is an inflationary pressure, is the U.S. consumer having to pay more for the same item. And so that is a risk that is important because the Fed spent the past few years trying to get inflation under control. And so anything that would be counteractive to that objective does pose some risk. With that said, we want to think about risk and the size of risk appropriately. And so I appreciate this chart. This is basically saying, how much revenue of the aggregate S&P 500, focusing on US companies, is coming from countries that, at least in the headlines recently, have been affected by tariffs. And so I would say China is the most notable, albeit Canada and Mexico were, I would say, kind of tag team in those tariffs just less than 2 weeks ago. The point of this is it is not uh, an outsized percentage of revenue, but it's also not small enough that we shouldn't care about it. And so our take is that this is a fluid situation. It's not responsible to take major swings one way or the other, especially with the evolving landscape. We are very curious and interested to see how some of these tariff conversations play out. But until there's more certainty around that, we're not making major changes in client accounts. So I do want to ask Adam and Jill, is that fairly consistent with what you've heard elsewhere and what you've expected from William Blair?
It has been. I mean, I appreciate you explaining it. And that's one of the standard questions when we have our review meetings with clients are tariffs, because as we all alluded to, and we see it ourselves, that's the only thing that's being talked about on the news. So we know that all bad news is on the news, and that's what everyone pays attention to. But explaining to clients how it affects the S&P, how it affects our markets, what companies are planning for, what they've already built in. So you've just explained it, and I think that will be helpful to our clients listening to this.
One other thing too that is not in our materials, but it takes us a little bit further in thinking about, yeah, tariffs could be inflationary, but what do they also mean in terms of growth of the economy? And I think the punchline is they will certainly take a bite out of economic growth, but probably not as big as people fear. And so I had some notes this morning. If GDP has been averaging around 2.7, 2.8%, which is a very healthy clip. Historically, it's around 2% in terms of US economic growth. Right now, China is really the only country that does have tariffs imposed. I think we all heard that Canada and Mexico, there's an extension for when tariffs go into place. So China is really the only one that's effective right now. But if you took just China on its own, then you would have, I think, about 0.3% deducted from overall GDP of the United States. So we go from, let's call it 2.3 to 2.4. And if Canada and Mexico factor in, then the combination of tariffs with those three countries would take our GDP from, let's call it 2.7 down to about 2.3, 2.2, 2.3. So it takes some of the growth out, but it's not going to cut it in half. It's not going to be maybe as meaningful as people fear. And so that's something that we think is helpful, just because, yeah, people are hearing about it. It sounds a little doomsday-ish, but when you actually kind of look at the numbers, we have a huge economy. We have a lot of global trading partners, and these will have some impact, but they're probably not going to knock us off our growth path.
And do you agree that it's factual. President Trump's not the only president to ever use tariffs. Every president has used it in some facet. I feel that our president is just a little bit more vocal, and the news is grabbing it, and that's why it's or at the forefront of everyone's mind. So I think addressing it again on this call for our clients is important, but to think that it's only our current president is not accurate.
You're absolutely right. I think you put it well when you said that he's more vocal about it, because he is and has been from day one. And it really shouldn't come as a surprise that we're talking about this. But this is a tool that's been used for many, many presidencies for sure.
Again, we work arm in arm with our clients and work arm in arm with our partners like William Blair. And our job is to kind of, one, custodian and be fiduciaries of our clients' wealth that they've amassed, which creates their income, creates their security, creates their livelihood. And they hear all this noise out there, hence the reason why they've hired Forefront, and hence the reason why we partner with William Blair to manage their money. Um, what is the mechanics when William Blair is looking at this from a longer period of time? And what I'm getting at this question is, look, there's headline news every hour. Um, but then we have economic prints, what's actually happening in the world. So how much of this is noise and how much of this is really taken into the portfolio on a day-to-day, month-to-month, quarter-by-quarter basis?
Yeah, it's a great question, Adam. I think there is a lot of noise that's out there right now, and I think that's our job, and it's part of the reason that we're part of a broader team. People have different areas of focus day in and day out, and it's to try to help filter out the noise and then also take to the side, okay, what is more meaningful? What do we need to think about in terms of what we're implementing in portfolios and decisions that we're making? And so I guess from a mechanical standpoint, when we really get down to the micro level, the specific investments we're buying, I think it's important to go back and revisit a little bit just our investment philosophy and process. And ultimately that revolves around making investments in quality businesses. And our feeling is quality businesses are defined as businesses that have some sort of technology or competitive advantage that gives them staying power and competitive advantage. They're run by, good people with integrity who maybe have a good track record of success, and then ultimately have a good take on how they manage the accounting and the finances and things like that. So by focusing on those things, we tend to invest in businesses that have a little bit more control over their own destiny and maybe aren't going to be as susceptible to what may or may not happen in Washington or what may or may not happen with the Fed. These businesses have a level of insulation. I'm not going to say they're fully risk proof, but there's a level of insulation I think that comes in investing in quality businesses. And so that's one of the big mechanisms I would say as we're taking all of this information, trying to process it, trying to distill it, separate out noise from what's more consequential, and falling back on that quality approach and businesses that do have the ability to navigate things a little bit more freely as opposed to what some soundbite may dictate. So we're not looking to make a quick buck. We're not looking to make a quick trade and make money over the course of the next week or 6 weeks. We're looking to make investments for the long term. And yeah, there might be things that come along the way where if we do get significant tariffs in China for an extended period of time, for example, and then there's retaliatory tariffs that come from China, maybe we have to look more specifically at some of the businesses we own where there is more of their product is made in China or more of the suppliers are in China. So there are little things like that from a mechanical standpoint that we will have to look at. Right now, this is just a big negotiation that's taking place. So it's noisy and it feels a little scary, but some of the flow through implications are maybe not as bad as people fear. There's other things too. I mean, right now in general, we tend to have less international exposure. And that was really due to, hey, the US economy is on pretty good footing. You have conflicts, major conflicts, wars in other parts of the world. We also have this potential new president who's coming in who's going to be more US focused. So, higher level structurally wise, we've said, why would we move away from the US and start going international when it seems to be that might be a trickier spot? So there's kind of that high level thinking, where's the puck going? But then also just having high quality businesses across sectors, avoiding some of that concentration risk, having businesses that might be a little bit more insulated from some of the noise. And I think that ultimately leads to good long-term results for clients, hopefully less volatility, a smoother ride. But that's what we're trying to do, day in and day out. We might not be trading day in and day out, but it's stuff that we're thinking about, stuff that we're talking about. And when we feel that there is something that's more meaningful, it's not just noise, we will act upon that and try to make the best decisions that we can.
So, to follow up with that from a setting expectations for the year. Again, this is Q1 2025, coming off of a 2024 where most institutional investment firms that we work with, and we have access to over 40 different firms and their comments. And so last year, the comments basically, when we were sitting here in January, early February of 2024, was that, we're in an election year, market's going to be up early, flat to down, and then up at the end of the year. For the most part, that's really where it ended up. The first half of the year is really where the sun was, where people made their most hay. And your last chart showed that Q4 was actually kind of a muted quarter across the markets, and some markets actually some indices negative. So it followed the pattern. And our experience being in the industry as long as Jill and I have been is that markets kind of they start to repeat themselves, right? They're not exact, but the patterns start to repeat themselves. So we're in the first year of a presidential election. That's just one overlay. We're in an environment right now where the AI world is kind of in the first to second inning of its industry, and it's taking over the corporate America in all different places, and it's still evolving. So we're hearing that 2025 is going to be a positive year, but with a little bit more chop to it, a little bit more volatility, because last year we did not have the volatility in place. So what's William Blair's base case for 2025? In the base case, we're not looking for, hey, this is what it's going to be, but based on all the economics data that you have, what do you see the pattern happening this year based on the facts on the table right now?
Yeah, good question, and not an uncommon question. As we start the new year, I think in general, the feeling is we should have a positive year for investment portfolios, for markets, but probably not as positive as it's been over the past few years. And so for us, I think, at least in my mind, a base case for 2025 is to be more normalized in terms of portfolio returns. So again, I think I quoted the historical return for the S&P 500 year in and year out is about 7 or 8%. So for us, we're thinking those kind of mid-single digit types of returns for investment portfolios feels more reasonable this year, but it will be a little choppier. And again, you're starting to see it right now. I think there's a lot of uncertainty again around what was said on the campaign trail, what is trying to be implemented right now, and then what turns out to be reality. So I think the first half of 2025 is probably choppy, maybe even looks similar to what the beginning of 2024 was like, where we're flattish, maybe slightly up, as investors try to get a sense of, well, what is going to take place from a policy standpoint? How does that impact my investments? And then I think as we get further into the year, hopefully there is some clarity around some of those things. And it's not only policy, but what are the downstream effects? I think Alex just said we got an inflation number this morning that turned out to be higher, meaning inflation has ticked up a bit higher than expected. So is that the beginning of a trend, or is it just a little like whack-a-mole popping up and then the next month's reading is going to be down again? That's a big question mark. Unfortunately, I don't have all the answers here, but I think there's going to be some of that up and down from a different economic data points. But at the end of the day, the economy continues to be on really solid footing, and we would have a hard time seeing that be derailed in a major way. So that's why more normalized sorts of returns, I think, could be expected in 2025. You're absolutely right. The artificial intelligence wave is still very much in its infancy, first or second inning. Some would say we haven't even left the dugout in the first inning. I think that's a little ambitious, but there's a lot of talk around people, businesses needing to buy all these chips, and that's why NVIDIA did so well. But as the infrastructure build gets a little bit longer in the tooth, that's when really the software starts to be so important. So unlocking all this processing power, all this data, that's where software is going to be so important. But this is a decade plus theme that, again, we're so early on. Between that, defense spending, a strong consumer, and again, generally a set of administrative policies coming out of Washington that should be more favorable for growth, we still think a good year, probably mid single digits in terms of overall returns, maybe not the 25% plus that we've seen over the past few years. But you know what? We're okay with that. A more normalized set of returns feels, we're still very comfortable with that. And I think that's our general expectation as we go forward. But it might be a little bumpy along the way, particularly early on in the year as we try to get some answers around the question marks that are floating out there.
What about, and again, you've answered it, but I'm going to just double click on it from the standpoint of the R word, the recession word. Everyone wants to, when I say everyone, we want to look at the extreme versions of it. Your economic data that you're just pointing out doesn't show that there's a recession is a high probability this year. That's what all the investor firms are also using as their base case. But now you have the federal government going through a massive redevelopment or restructuring, which costs jobs.
Yep.
And so that can actually now start pushing up the unemployment numbers, which then is one of the economic data pieces that could drive recession. Any worry about that from that the massive layoffs or the looking like potential massive layoffs and people taking packages and lowering people working now could actually have a flip side effect into the jobs report and the unemployment report?
Yeah, so it's a good question and one of those sort of philosophical questions to ponder. I don't know off the top of my head the number of federal employees or government employees and what their percentage is as part of the overall workforce, but that is certainly something that could create some jitters in not only for labor markets but also broader economic implications. I guess some of the counterbalance to that is one of the other, we've talked a bit about tariffs. The other big sort of policy piece that's on the table right now is, do we start to deport people and ultimately shrink our labor force? And that could have inflationary pressures and economic growth pressures. But in some way, strangely, if there's people kind of being forced out of the country, does that create some other job openings that maybe people who are displaced domestically? Is there a little bit of a shift that potentially takes place? I don't know. I don't know how much of that is actually something we might see in reality, but the job market in general is pretty dynamic, and you could see something like that. If people are shipped out, what happens to people, U.S. citizens who are here who might be, leaving another job, whether it's under their own free will or not? Do they start to absorb some of those potential openings? I think that's possible. But I guess at the end of the day, we still think that the possibility of fewer federal or government workers probably does not tip us into a recession in 2025. I think maybe one of my more concerning long-term concerns is more so about the debt that the government continues to take on. And so I worry less about recession in 2025, but as we get further out, 26, 27, 28, even further, as it's weird to say 2030, but we're not that far away from it. You start to see as the deficits grow, as the U.S. debt grows, and with some of these policies that would actually increase those things, I do start to get concerned as we look, 5 to 10 years down the road. what is happening with the debt that we're taking on as a country. How do we service that? I still don't think the R word is something that we're seeing for 2025, but definitely some of that pressure builds. There's kind of that cumulative effect. If we do see a lot of layoffs this year, what's that more cumulative effect as we look into 26, 27, and beyond? I think we're okay for now, but definitely want to keep our ears perked up as some of this stuff evolves and we get more, more data and more clarity.
My last question, that went more on the negative of the concern, and quite honestly, it's not a concern of mine. It's just a factor that comes into it. And I do see that the you you know taking apart government waste, if there's government waste, it to me, that's like running a good business. You want to run a business as efficiently as possible.
Mhm.
So I'm all for it as long as there's a plan in place.
Yeah.
On the flip side, the opportunities now, potentially, and again, and this is still government related, but going back to the AI world and the fact that it seems that the new administration seems to be more deregulatory, and by becoming more deregulatory, less draconian, less rules based, and giving more latitude to individual companies to prosper. Do you guys have that factored in? And does William Blair see that as maybe an upside to more of the smaller firms and the mid-sized firms in this country, or different sectors of this country that have been beaten up, but now have some opportunities to really thrive under a more deregulatory environment?
Yeah, absolutely. And I think that's one of those points that does filter into our more constructive outlook for 2025, just the more constructive backdrop. I think a big part of that is less regulation, less red tape for different businesses, industry sectors to have to deal with. And I think it could be pretty broad-based as well. One of the things that our global economist talks about is, yeah, there's a lot of excitement around AI, and you can ask questions and do all this, but the bigger wave is there's an expectation of an increase in productivity across the labor force as a result of artificial intelligence, and businesses actually able to implement it and use it. And so over the course of history, you've had these periods where productivity has increased in a significant way. And so we feel like we're really on the precipice of that taking place. So that, as we go forward, that's something I think bigger picture to keep in mind is just the expectation of an increase in productivity for not only US workers, but a global workforce where it's really technology is empowering. So that's the hope. But yes, regulation or deregulation, we think can be helpful across sectors. I think some of the obvious ones, in the energy space, for example, less regulation around that is certainly helpful. But healthcare, for example, is a big area that we have historically been investors in. And healthcare is exciting because you have all sorts of different areas. But that's a spot that has really underperformed over the past few years. While technology has had a lot of the spotlight, healthcare has underperformed. So we're seeing some really interesting, device companies, medical device companies. You're also seeing a lot of innovation, obviously, in the biotech space or in pharmaceuticals. And so there's a lot of talk around deregulation in those areas, which we really think helps to allow companies, gives them a little more breathing room to innovate, to try things, to experiment, to engage in research and development. So we're pretty favorable on the healthcare space right now. There's other areas too within industrials, and again, if we're thinking about still being on strong footing from an economic standpoint, but if there's more kind of a U.S. first feel, there's less regulation. Just being able to kind of build stuff here, more of a manufacturing renaissance, a homegrown manufacturing restaurant renaissance. That's something that we're curious to see how that progresses. We think there might be some nice tailwinds there, and it's so broad, whether it's robotics or environmental abatement or just the industrial complex in general that helps to support other businesses. That's an area that we think could benefit broadly from less regulation and just a little bit more room to run. So some of the trading activity that your clients would see, I think, is reflective of some of those themes. And along those lines too, looking at smaller and mid-sized businesses, which again are going to have less exposure to international pressures. They're going to have less exposure when it comes time to exchange, the local currency for the US dollar. Well, small and mid-cap companies a lot of times don't have to worry about that because they're domestic oriented. So that's an area that has been underappreciated as, again, large cap technology has done so well. What are those small and mid-cap domestic businesses that should benefit from a more favorable regulatory environment? And depending on what the Fed does as we get further into the year, if they start to cut again, that could continue to relieve some pressure on some of those small and mid-sized U.S. businesses as well. So that's another theme I would say that we're constructive on as we continue to get into 2025, and we think those sorts of businesses, smaller mid-sized businesses, could benefit from less regulation and some of the other tailwinds too.
Well, I'm going to ask one more question, then we're going to wrap up. This went longer than we thought, but I think the conversation's been phenomenal, and so I hope our clients have been enjoying it. The last question I was going to ask is more. It's not really a stock market question, but it's an economic question. It was one of the indicators that you call sticky, is the real estate market, and we have a concern with there's obviously a concern of the cost of housing in this country. With that being said, is there more of an opportunity now for the real estate market to change, or are we still status quo in the real estate market with interest rates being high? What's going to basically break this cycle so that the real estate market kind of opens up across the board for the economy?
Yeah, great. Another great question, another big question mark that is floating out there. And that's been the tricky thing. I think on the residential side, we have, far too few, millions of units of residential that we need relative to people that are looking. That imbalance there creates some pressure. And mortgage rates still remain quite high. You're looking at, 7% plus mortgage rates nowadays. Some of the challenges, and this may take some time, is that, one of the benefits, one of the reasons the economy has been so strong is that really consumers and businesses kind of locked in favorable rates 5, 6, 7 years ago. And even to some extent before the Fed started to raise again, you saw a lot of people refinancing mortgages and debt and things like that. So people are locked into good debt right now. And so that takes a little bit of time to work itself through. But you are seeing, I think, some creativity start to come in, and I think this should be helpful in, I don't want to say, clearing the path, but I think there's probably not going to be a scenario where we get, again, like this big scary crash and break and things like that people were calling for. A big issue that we've all experienced is, people going back to work. You have all these buildings, these skyscrapers, all that people aren't using anymore because they're working from home mostly, or there's this hybrid environment. People said, "Oh, commercial real estate market is going to crash. Nobody's going back, blah, blah, blah." Well, I don't think we've really seen that yet. And I think, and at least speaking from our own business perspective too, the flexibility and the creativity, I think, has prevented a bigger break. And you're seeing other things. I think about, malls, for example. People talked about this Amazon effect where physical stores, brick and mortar stores were not going to exist in the future because of Amazon. Everyone's ordering things online. Well, I drive past malls and shopping thoroughfares and things like that. There's still a lot of activity there, but other areas within that shopping area have been repurposed. So you see like a big former department store has now been turned into multifamily housing units. And so that I know that's one little case, but I think there's an element of creativity and thinking beyond just, well, this is zoned for this, that's all we can have here. No, what if we had this zone for multi reasons, multi sorts of properties? So I think that creativity, trying to meet, supply with where the demand is, repurpose areas, repurpose buildings. I think there's that creativity is going to be helpful as we navigate the real estate market. Yeah, there's a lot of the real estate market is complicated, residential, commercial, industrial parks. All these server farms need places to go. Amazon needs places to ship and operate out of. So it's a big, complicated monster. But again, that creativity and being able to shift things, I think we probably don't have as big and scary of a correction in the real estate markets as maybe feared, but it's going to continue to take time for some of that pressure to abate and some of those dynamics. Again, what's the Fed going to do or not do? If they cut again, in the coming months, do we start to see us get back on this track where mortgage rates come down potentially? And so our hope is that that turns out to be the case, but it's nothing ever happens as fast as we want it to. And I think again, the idea of expectation setting, real estate is going to continue to take some time to work through and navigate. But we are confident that some of that creativity and repurposing can be a really positive thing down the road.
Jill, any other questions coming in?
I don't have any other questions. What I would say to any of our clients, if you didn't feel comfortable jotting or putting that in the chat or the Q&A, feel free to reach out to Adam and myself, and we'll make sure to get back to you on any of the questions or concerns you have that came out of this. I want to thank Alex and Randy so much for your time today and taking the hour. I know our clients appreciate it. I know we do. We'll be making this video, once it goes through compliance, available for all of our clients. We'll have it on our YouTube channel and on our website, so they'll be able to refer back to this. So thank you both for today and for your time.
Thank you.
Thank you, Adam. Thank you, Jill.
Thank you all.